we kind of pool our lenders into three different groups. So we have what we call our A lenders. So that's the big lenders, the big banks, that's where you're going to get your cheapest interest rates, your best deals. Then we have the next group over, which would be what we call B lenders or subprime lenders or alt A lenders.
Why would you use a private money lender versus just go to the bank?
The main reason that people use private lending is they just don't qualify with an A bank or a B bank because of their credit. And then the third one is, and this one comes up quite often, is they just need the money for a short period of time.
So in Canada, do you is it more common to use a private money lender for buying a home?
No, not necessarily for buying a home. So with our private financing solutions, we generally tell people this is a short-term solution to get you from point A to point B, okay? And so there may be...
Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Steven Loewer. Steven is the founder and CEO of Lions Den Capital, a private lending and investment firm he launched in 2015 with a mission to help individuals and business owners build sustainable wealth through mortgage-backed opportunities. I actually really love the name Lions Den Capital. That's one of the cooler capital group names I found. So cool. I figured I would mention that. But first, Steven, thank you for coming on the show. Thanks for taking the time.
Thanks for having me. Appreciate it.
Very excited for the conversation. But let's start with a bit about your background. It sounds like you started Lions Den in 2015, but give us just a little bit about yourself and what kind of brought you to where you are today.
Sure. Yeah. Appreciate it. So I grew up in Canada. I'm in Western Canada, and I grew up as one of 7 kids, so a pretty big family. Mm-hmm. I'll give you, just because you mentioned the name, I'll give you a quick story about the name. So my dad always had a good job. We had stable income. We didn't ever want for anything, but we didn't have an excess of anything either. So I always felt like we were one of the poorer families. Mostly just because we had so many mouths to feed. Mm-hmm. Anyway, so mom would always try to do her best to have a side hustle of some sort. She was very entrepreneurial. She grew up on a farm. She was hardworking. And so she would buy a big truckload of fruit from British Columbia, and she would sell it out of the garage box by box. We would be hauling out fruit all summer long. She would do all these different things to try to just, make sure we had enough, clothes and shoes to go back to school come the fall. Anyway, eventually one time she got asked to do this family reunion for her big extended family that she had. And so she was looking for books and resources on how to throw a good family reunion and couldn't find any. And so after she finished doing this family reunion, her and her sister decided we're going to write a book so that other people can, learn what we learned and have this resource. Anyway, of course, mom being the entrepreneur, she's like out there hustling, trying to find some publisher for this book. Couldn't find anybody to publish the book. And so she, of course, being the entrepreneur that she is, she says, well, forget that. I'm just going to start my own publishing company. So she started a publishing company and called it Lions Den Publishing. And so we named our company Lions Den Capital in her honor. She unfortunately passed away from cancer in 2004. So that's how we've memorialized her memory in the business and everything that we do. We look to try to be super resourceful, finding solutions for things when things get tricky. So that's a little bit about Lions Den. So, but in further to that, my parents decided when I was probably about 10 or 12, they got into buying rental properties. And so they joined a local real estate investment group, learned how to, buy rental properties, how to manage rental properties. And again, my mom having this brilliant idea of, she recognized I'm not going to have the resources to put all of my kids through university like I would like to. And so she said, but maybe I can help each one of them buy a house or buy some sort of a property. Mm-hmm. And if I can help each of my kids buy a property, I know that, through mortgage pay down and appreciation and all these benefits of owning real estate, that hopefully they can use that to either pay for their education or grow some wealth long term. And so that was her goal, was to help each of us buy a property. And so I was lucky enough, and each of my older siblings, she helped them buy a property, and everybody got to do that. That was pretty cool. And when I was 19, I had a little bit of cash saved up. And so they found this opportunity where back in the day, you could actually assume somebody's mortgage without qualifying. And so, I was this 19-year-old kid. I was working some labor job earning, minimum wage or just over. And I took over a $198,000 mortgage from somebody who had just bought a house, built a house, lived in it for a little while, had only put 3 or 5% down or something, and decided that the commute was too far and they wanted to get rid of it. So I took over this mortgage, and I was able to get my first rental property when I was 19. So that was pretty cool. The only part that my mom actually had to be involved with was they just like, we don't feel super comfortable with some 19-year-old kid signing, taking over our mortgage. So they also went on the deal just to give them that comfort. So that's kind of how I got my intro into the real estate world. And as I was going through university, I was good with numbers. I knew I wanted to do something with numbers and real estate. And I came together with kind of real estate finance is kind of where I ended up. The first shop that I ended up with, they had a fair bit of experience with the private lending world. And so I was introduced to that concept of, you can borrow from banks, but you can also borrow from private institutions or private individuals who also have capital that want to lend it out. And so that was my first introduction to that. Unfortunately, the timing was pretty poor because I was training to be a commercial mortgage broker, and then 2008 hit.
Yeah.
There's some sort of worldwide financial crisis that happened, and
something happened right around then that was
exactly
unfortunate. Right? Yeah.
And so there was nobody borrowing, nobody was lending, and so they said we can't afford to keep you around, but we could. They introduced me to this gentleman who was had a really unique business model. He was an apartment building flipper, and so he would buy small apartment buildings, fix them up, and then resell them within usually 3 to 18 months was kind of the business model. And so that's where I spent a ton of my time and really learned and grew my knowledge and expertise in the private lending world. So we would go out and buy let's say a 12-unit apartment building for $1 million. And so I would put together the capital stack with some debt, some equity, some hybrid, sometimes some seller financing. So we used all sorts of creative financing strategies to go and buy these properties. And then when we would fix it up and we'd go to sell it, we would also use creative structures as well to sell the property. And so that was really where I grew my knowledge and expertise in the private lending world. And then in 2015, I decided to go off on my own and launch Lions Den Capital. So that brings us to today.
Fantastic. A lot of things I want to talk about. One is your amazing mom. That's a very cool entrepreneur origin story. Just so cool that she did that stuff and was able to. It's fun. It actually reminds me a lot of my grandmother. My grandmother had 7 kids. The things that I think a different generation, but the things that happen, when you're trying to just do all that you can for that many kids and make sure everybody has food and and then 7 kids, and then I was actually the first grandkid to come along and lived with my grandmother for a while but I always remember this. I don't know if your mom did this or what, but water in the milk. That was the thing that stuck in my mind. Water in the milk to make the milk last longer, which is pretty gross when it starts to get watered down.
We did powdered milk for a long time growing up. I remember that, which is probably even worse. But
that is,
I don't know if that's interesting. I now looking back, I wonder if mom ever watered down the milk.
Yeah, hard to get grosser than water in the milk. Depending, how far down, how much long the milk needs to last, and how much water gets added. But I think that stuff to me is super powerful and inspiring, and it just makes you, some of the stuff that we maybe complain about now, my DoorDash wasn't right, the stuff, the stuff that our earlier generations had to deal with is if we think back, we've got it pretty good. So so love that. Thank you for sharing the story about your mom and the fact that she wanted to get property for each of which is now I think people talk about that a little bit, but it's such a good idea. It's such a good way to set your children up for the future. I think people is kind of looking at what do I do? And it's if you can somehow manage to have your child have a property at even 19, but sounds like maybe she was doing it earlier. You hold that, most mortgages are 30 years long. Like, you're going to have that if you hold on to it forever. It is a very, very good asset and can lead to, a lot of understanding as you developed through your career, understanding of that, the real estate asset class and all the different ways you can be involved and stuff. So, I mean, such a cool, I guess, inspiration to have as a young person. Also notable that they would let a 19-year-old assume someone else's mortgage but relevant to the fact that everything crashed in 2008 for just those particular reasons. Like that, right. The first mortgage I ever got no business getting a mortgage. I wasn't assuming one, but I had no business being given the mortgage that I did. So I was lucky enough to do it early enough in that cycle to not get hit too hard. But so you worked for an apartment flipper, which I would assume is very similar to a house flipper, just at a little bit larger scale. I kind of look at apartment syndication that way. But we're involved more on the financing side, it sounds like. So
yeah, we were a pretty small team, and so we really had somebody that was doing the acquisitions, which a lot of it was direct to seller.
Yep.
And then we had myself, who basically, as soon as there was a deal that was under contract, I would start doing all the due diligence, putting together the capital stack, doing all the underwriting, making sure it was a good deal, and then getting it to closing. And then after it was closed, then we had somebody else that was dealing with a little bit of the property management. I stayed out of that. But then again, when we had it repositioned and ready to sell, it was always a question of, do we put some financing on it and then sell it and, do some creative terms for a carry, or do we keep the, short-term financing in place and just continue to offer other options? So there was involvement all through the process. And then again, when we would sell the property, I wasn't super involved in that marketing process. So basically, other than the acquisition, property management, and the disposition, I was in charge of touching a piece of all of that. So it was this really awesome experience and opportunity. And during the time that I was there, we bought and sold over 750 units in total and did about 200 million in transactions. And so there's not a lot of people out there that buy properties that have that much experience, sometimes on the volume, but not necessarily on the amount of transactions.
Yeah.
Because our average deal was, like a 10-unit apartment building, right? So it was really unique to be able to, process and see all the different things that can go wrong in a transaction and see all the sneaky things that, or mistakes that lawyers make and things like that. We had this one closing. I'll give you a quick example. Is we sold a property, and I went over to the law firm to grab the payout check for the sale, and I was looking at it going, this seems like it's 150 grand, way too high. Something's wrong here. So take it back, talk to the team. I'm like, I think I know what happened here. Took it back to the lawyer. I'm like, I think you guys forgot to pay out the second mortgage. They're like, oh, wow, yeah. Anyway, so no harm, no foul, but honest mistake, and these things happen. But anyway, there's lots of fun stories about what can go wrong and what does go wrong in a transaction. So
yeah, I'm sure. Well, and I sitting in that particular seat, I actually think that's pretty unique, at least from my experience. And as I mentioned before we started recording, I haven't really had I don't think anybody else on the podcast who very specifically was in kind of the lending part of these processes. I did want to ask you, and we touched on this just in the interest of making sure that people understand sort of the difference between private lending and just going to the bank for a loan. Mm-hmm. And so I'll leave it an open-ended question and let you answer it how. But I also have potentially a follow-up that I've been asked before that I'll probably pose to you as well.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Cool. Awesome. So I'll explain to you how it works in Canada, because that's the area that I'm most familiar with. And I'm sure that there's a lot of carryover into the United States. So we kind of pool our lenders into three different groups. So we have what we call our A lenders. So that's the big lenders, the big banks, that's where you're going to get your cheapest interest rates, your best deals. But they're also going to have very tight underwriting requirements, right? So it's very hard to fit into their little box. Then we have the next group over, which would be what we call B lenders or subprime lenders or alt A lenders, as they like to call themselves. And those are basically just outside of the bank requirements. So they would permit somebody that has, say, a lower credit score or somebody that has a harder time proving their income. And of course, because they're taking on a little bit more risk because of that, the interest rates are generally a little bit higher. And sometimes there may be a lender fee. And then the third group in Canada, we generally just call everybody there private lenders. And so that could be large institutions or just a private individual. I know in the US, generally, you guys like to break it into hard money and then private. In Canada, we generally just call them all private.
I'm still not sure what the difference is between hard money lender and private. It's
and everybody,
the same thing.
from
I don't know
the best way that I've gathered, the way that you guys use it, again, I think there's different people that use it completely differently all over the place.
Yeah.
But if it's a large company that is in the business of lending and is doing these types of loans all the time, you would call them a hard money lender. If it's a private individual or somebody that's, bob down the street type of thing, then it would be a private lender, a PML.
Yeah.
But again, I think it's always open for interpretation.
Same, right? Like the same, it largely, that money's going to fall in the same bucket. So no, I appreciate the explanation. The follow-up question I have gotten before, and I think the answer probably changes depending on where we are in a market cycle. But basically, it was the question I've gotten before is, why would you use a private money lender versus just go to the bank? Like, why don't you just go to the bank and get the loan? Like that's what I've heard people say that.
Yeah, great. And sometimes when we get a deal and we'll ask the same question, we'll be like, why is this borrower just not going to the bank? And so then we'll usually get some insight as to why. So there's usually a handful of reasons. One is either they don't have any credit history or their credit is banged up or bruised. Let me qualify one more thing quick before we jump into it. So in Canada, we actually do a lot of private lending to homeowners, whereas in the US, all of the private lenders that I hear talking generally don't lend to homeowners. They're generally lending to investors, real estate investors for fix and flips and things like that. So in Canada, it's a little bit different. So I'll break that down for you first. So the main reason that people use private lending is they just don't qualify with an A bank or a B bank because of their credit or because of their income. And sometimes it's not a matter of they don't make money. Sometimes it's just hard to prove how much money they have. And so that sometimes will push people to it. And then the third one is, and this one comes up quite often, is they just need the money for a short period of time. Okay, so if banks love to lend for like 25, 30 years, right? They don't want to lend for 4 months, 6 months, 12 months. And so if you try to take a deal to a bank and then pay them out 4 months later, they're going to get pretty pissed off. And they probably won't lend to you again, right? Yeah. So you might get, might be able to do that once or twice, but after that, usually you won't, they're not going to fall for that trick again. So if you're borrowing to buy a house, fix it up, and then sell it, most times you're going to be looking for private financing. And it's just because that's the nature of the business. The A and B lenders generally aren't interested in those types of loans.
Yeah, that is, and that's my understanding as well. I think it's and maybe that's why mostly investors use it here, because you're like typical person who's going to buy a house isn't looking to go to a private money lender for the loan on that house, at least not here.
Right.
Versus, your house flippers are like, well, I need this money for 6 months and then I'm going to give it back and then I'm going to do it again and again and again. Mm-hmm. And so they build those relationships that way. So in Canada, do you, is it more common to use a private money lender for buying a home?
No, not necessarily for buying a home. So with our private financing solutions, we generally tell people this is a short-term solution for to get you from point A to point B. Okay. And so there may be a challenge or a concern. I'll give you a quick example is you're going to go and buy a house before you sell your current house, right?
Right.
And so you go to the bank and they go, well, no, you don't qualify for this mortgage and this mortgage. So you got to sell this one first. And so that's an opportunity for us to say, well, we can give you a bridge loan to secure it on both properties. And then when you sell the one, you'll pay us out and then you can go and get your bank loan. So there's simple situations like that where the banks just aren't as flexible, aren't as creative, and just can't wrap their heads around. And that's another area too that I guess where private financing fits really well is if you just need access to capital very quickly. Mm-hmm. So, for example, if there's a really nice strip mall down the road from where you are, and you've been looking at this thing going, oh man, I'd love to own the strip mall one day, and suddenly the owner approaches you and says, this thing's worth $5 million, but if you write me a check today for $2 million, I'll give it to you, right? There's no bank that's going to be able to close on that within 2 weeks, say, right? So if you need access to capital very quickly, there's lots of private lenders that would be happy to lend you $2 million secured on that property because they know that, if you didn't make your payments, they'd end up owning it and they'd be pretty happy with that.
Yeah.
So speed of the transaction. And sometimes there's some lenders that can act very quickly. We can act pretty quickly, but we're always slowed down by the legal process. So we can always move as quickly as the lawyers can move. I know in a number of your states, you guys get to use title companies in that. So sometimes they can move faster than the lawyers can, which is great.
Yeah. Yeah. And that's actually an interesting example. I hadn't thought it seems like most of the time in the US when we have that overlap where someone's buying a house and selling a house, they'll typically make the sale of their house, the purchase of the new home contingent on closing the other home. And so it's got to be like simultaneous transaction or something like that. But that short little bridge loan would solve that problem quite well. I don't know. Maybe people do it here. I've never heard of it before. But so most of these shorter term private money loans are used by investors in general. If we're
100%, especially in the US.
Yeah. I don't want to generalize, tell me if I'm wrong, but usually the interest rates are higher on
great question.
than you would from like go to the bank sort of thing.
Yeah. And so when we look at A, B, and C, you're going to get your cheapest rates from your A lenders. Your B lenders are going to be a little bit higher, and then the C or the private lenders are going to be the highest. And there's a few reasons for that. Obviously, if you're lending out your money, and let's say you lend out $200,000 at 10%, and somebody pays you back, let's say 5 days later, you're not going to earn very much money on that, right?
Right.
So the interest that you earn is going to be very little. And so because a lot of the terms are so short, oftentimes they're fully open for repayment without any type of penalty. The lender says, well, I want to get compensated for that short-term flexibility that I'm giving you. And so that usually results in a higher rate. Now, the other area that they use in structuring these deals is they'll use a rate and then also a fee or points, as you guys like to call them. Mm-hmm. And so again, you can structure the deal in different ways with a higher rate or a higher fee, so that the lender's getting compensated properly for having that money out. So oftentimes they'll say, well, I want to earn a minimum of $10,000 or something, so I'm going to charge this amount of fee plus this interest, and then you can pay me out after 3 months or something.
Yeah. It's funny that we call them points. Another thing that I'm like, why? It's a fee. I didn't know that for a long time, but I was like, what are these points? These magical points they're talking about? And it's like
air miles. No, I'm not earning air miles. Yeah.
Oh, but if you do 3 points, your interest rate is lower. And I didn't realize that just meant I was paying them a fee to give me a lower interest rate. It's funny how the industries try to almost have their own language and make it far more confusing than it needs to be, but yeah, it's a fee. It's just a fee. That's what the point is. So in 2015, you started your own lending group. Tell me a little bit about the evolution of that, because I mean, from 2015 to 2022, everything was sort of on a pretty steady up. in terms of the real estate market, and then we've had quite a few challenges since then. So to tell me a little bit about how that played out for you in your business, and well, we'll
Yeah,
get to the future as well, but tell us a
sure.
little bit about how that time worked.
So again, it's pretty interesting. So in the past, Canada, we're a very small market, right? There's fewer people in all of Canada than there is in California, and so we in general would follow the U.S. in terms of monetary policy. And so if the U.S. dropped a quarter point, usually 3 or 6 months later we'd drop a quarter point. And so we were always kind of tracking like this, usually a little bit delayed. But shortly after COVID, that's where things really just started to come apart. So you guys have kept your interest rates pretty high, and we've actually brought ours down substantially. And so right now, our market has actually continued to grow since COVID. In terms of real estate prices, we haven't had a big drop or a flatlining like you guys have seen, and so that's been pretty interesting to watch happen in the markets there. But one of the nice things that I do appreciate is that because I've been in the business for so long, and because I started during this really tumultuous time where I saw these loans, and then I saw the fallout of what happens when the market shifts and you have a credit crisis. I've gone into the business with this knowledge and understanding of what can happen, right? Whereas somebody that's maybe only been in the business 5 years and has only seen this, they just don't know what to even look for, or the red flags to watch out for. So that's I think served me very well in how we approach risk, how we approach our underwriting. And so what we do in general is we always look at the worst case scenario. And so we look at a property and we underwrite it, and we say, okay, if we lend X amount of dollars on this piece of property, are we okay with the worst case scenario? And so I'll paint a picture for you of what that worst case scenario is. So let's say that Bob is going to go and buy a house for $300,000. He's going to fix it up. He's going to put about $100,000 into it, and then he's going to hopefully sell it for about $600,000. Right, some nice juicy numbers. And so Bob comes to us and he says, "Hey, I want to buy this house. I want to fix it up, and then I want to sell it." Shows us the business plan, shows us his experience, and we look at it and say, "Yeah, sure, we're interested in doing that." So now we got to figure out, okay, what loan amount are we comfortable with? And so I'll paint the picture of a worst case scenario. So let's say that we advance X amount of dollars, and 2 days after closing, Bob goes in, he starts doing his demolition, right? He's moving walls, he's changing plumbing and electrical and things like that. And then Bob just gets abducted by aliens. Bob just disappears. We don't know where Bob is. Nobody's there fixing up the house. Nobody's there to pay the taxes. Nobody's there to pay the insurance, to pay the mortgage payments. And so suddenly we realize that Bob's missing some payments. Bob's not returning phone calls. And so now we got to figure out, well, what the heck do we do now? And so now we have to figure out, okay, and we'll go visit the property. We'll try to contact Bob's relatives, whoever we can, like, where's Bob, right? We can't get a hold of the guy. So then we have to unfortunately engage an attorney or to start enforcement proceedings. So then we look at that and say, okay, based on the jurisdiction that I'm in, what does that timeline look like? It's going to be different in every province, state, no matter where you are. And then usually one of two things will happen. Either the property will get listed and sold, or the court will hand the title over to the lender. And so we have to look at either of those situations and scenarios and say, okay, are we comfortable with that happening? And if so, what loan amount makes sense for us to lend if the worst case happened? So that's basically how we approach these deals. And then of course you have to build in there some market risk, some interest rate risk, some construction timeline risk, things like that. So all these things come into play, and then we get comfortable with a loan amount that's reasonable. So our style is we're very much what we call an asset-based lender. So if you have enough equity in the property, we'll generally approve you for the loan, because we know that if worst case happened, we could sell the property and get our capital back and move on to the next deal.
Right.
Yeah.
That sounds like, at least for what my familiarity is here, that sounds reasonably conservative, like not to the level that the A lenders, like the big banks, are, but does sound like I get a lot of things from hard money lenders that are like, oh yeah, you can buy this flip, you have to put zero money in and we'll pay for everything and the construction costs and blah blah. I'm sure there's some caveats to that once you actually get into the loan process. But do you feel that are you more conservative than other private money lenders? Maybe the same, maybe like, I don't know, kind of where would you categorize yourself in that, your risk, your willingness to take on risk?
Yeah, good question. So there's a number of different ways that private money lenders operate, and oftentimes it's based off of where their capital is coming from, right? So if you're lending out capital and you're being funded by, let's say, a pension fund, that pension fund's probably going to have a pretty minimal risk tolerance, and so you'd probably have a very conservative underwriting and ability to approve loans. Whereas if you're just independently wealthy and you've got an extra $1 million that you want to play with and you want to lend out, we know of some people that just they treat it a little bit like a game. It's a little bit exciting for them. It's a little bit like gambling. It's a little, right? And so they're like, let's take the risk, but I want my big number return, right?
Right.
And for them, at the end of the day, if they lose it all, they're like, I'll just write it off against my other gains, right?
Right.
So everybody's a little bit different. So when it comes to our underwriting, again, because I've been through a couple of those market cycles, we're pretty conservative, but we also go to the next level, I'd say, in creativity to try to say, this is a good deal and we want to help you make it work. What can we do to get this deal to work? So that might be, hey, do you have another property that has some equity that we can also use as security? Or, hey, you don't have as much experience with this. Do you have a partner you could bring on to co-sign that would, add some strength to this deal to help reduce our risks that we feel comfortable?
Okay.
It might be, do you have any other assets? We've even taken, vehicles or trailers and things like that. Do you have any other things that we could liquidate if things went sideways, et cetera, et cetera? So we always try to find a solution, or at least say, well, this is at least what we're willing to do. Is there some way that you can, come up with the difference, bring on a joint venture partner that's going to inject some capital, et cetera, et cetera. So we generally don't just come back with a no, right? Whereas if you've been to a bank, the banks just love to go, no.
Yep.
It's like, what do you mean no? Like, how much am I approved for? No.
Yep. No explanations.
Yeah. Not approved.
Yep.
And so, that's our goal. And so what I teach people is, and so just to be clear, so we have kind of two businesses that we run. We have our lending company where we actually manage money. And so we lend out our own capital, but then we also have high net worth families, individuals, and family offices that have come to us and said, you guys are good at what you do. We want you to manage our money for us and help us put it out into these mortgage opportunities. And so the other area of the business, so that's one where we actually are active lending. The other area of the business that we run is we teach people how to do this on their own. And so we have a course that we teach. We teach people, how to find deals, how to underwrite them, how to mitigate the risks, how to price them properly, and then how to ultimately get it funded, and so that they're well secured and they can go out and earn these returns all on their own. And so for first mortgages, we generally say that the range should be somewhere in that 8 to 10, maybe 12% range. And for second mortgages, it's usually 10% and up. Again, second mortgages, of course, are more risky because you're in second position. So you've got to make sure that you've got the capacity to at least deal with the first mortgage in to some extent. And but that's where the bigger returns are. So some of the guys that I mentioned that love the risk, they're like, second mortgage is only 15% plus. That's where I want to be. Now, the nice thing too, of course, if you're lending out your own capital and learn how to do this on your own, is not only do you get the interest rate, but you also get to charge that fee. Mm-hmm. And so for a typical deal, it might be a 10% interest rate and a 2% fee, for example. And so if you lend that money out for 6 months and you get paid back, that's a 12%. So you earn six on the rate. What did I say? 10 and 2 or 12 and 2?
10 and 2. 10 and 2.
Yep. So 5 on the rate for those 6 months plus a 2% fee. Mm-hmm. So you annualize that, you lend it out again. You're going to be at what is that going to be? Probably a 14 to 15% return.
Yep.
So for most people that are getting started, I highly recommend starting with first mortgages until they've done a few, they understand the process, they get comfortable with it. I know of way too many people that have jumped into second mortgages and with different levels of background and understanding. And I'll have interviews with them like this and ask them a little bit what they're doing, what they're looking for, and they'll say, "Oh yeah, I did four private mortgage deals. I loaned out $245,000, but unfortunately, I'm not getting any of that money back." I'm like, "What?
Yeah.
No, that's not how this works, man.
That's not how it's supposed to go."
No, exactly. So clearly they're not following a process. They're not, they don't know and understand how to secure their loan properly. And so I know and understand that people get caught up in the excitement. Somebody pitches them like, "Hey, I'm going to do this fix and flip and we're going to make all this money and you're going to earn 18%, blah, blah, blah." I say, whoa. No, if this is your first deal, like, first of all, don't get super excited about the return, because even though the return sounds great, if you get $0 back, it doesn't matter how amazing the return sounds, right? That's not worth taking that risk. So there's two rules in investing, right? Number one, don't lose any money. And number two, see rule number one, right? So that's why we love private mortgages. It's always secured. We generally will lend to a loan to value where we feel comfortable, where if that worst case scenario happened, that we know that we could at least get our principal back. Yeah, very smart. I'm kind of thinking about, I said we haven't really talked in this much detail about private lending on the podcast in the past. And, but what I have talked about a lot is just that there's so many different ways to be involved in real estate. Like, that's to me, like, one of the coolest things about owning assets in general, like what real estate, whatever, it's there's all different angles, and lending is a huge piece of it. And being on that side of it, like, sure, you may have to foreclose on some of these here and there, but like, you don't have to deal with the tenants or anything like that. You just, it's not easy, but at the same time, it's like, you're not doing that, some of the parts of real estate that people don't like. And so you're still involved. You're still a part of that, process, and frankly, a part of the process that is very necessary. Like, most real estate assets are bought, they're levered. So there's some sort of lending behind that, whether that's a private money lender or a hard money lender, which I still believe is the same thing, or a bank. Like, it's all, somebody's there, and they're often the biggest investor in whatever that deal is. And so it's such an important piece of the puzzle, and probably something I didn't understand and appreciate enough of when I was initially getting into real estate. And I got lucky because I did some of those private money lending and got the money back and made, it went fine. But like, I'm sure I didn't adequately figure out if there was going to be a problem, what would happen. So I think it's great that you have that coaching piece as well to help people that want to be involved. So it is, again, just added to the list of great things that you can be involved in real estate as a part of, and all these different components. So one of the things that I has really kind of sunk in with me the last few years is, we have a number of wealthy clients that we put money out for, but I look at, the average Canadian, the average American that's struggling to get by, and they're trying to grow their net worth. They're trying stocks, they're trying Bitcoin, they're trying to do all these different things. They're doing their own side hustles. And I look at it and I go, man, if I could only teach them what's possible here. It's not a get rich quick scheme, right? Yeah. Earning 10, 12% is not going to get you, millions of dollars in your first year, right? This is slow compounding wealth building. But if I can teach that to people and help them grow their net worth, grow their retirement accounts, and be able to, complement their life. I'll give you an example. So we have this nice old couple, super hardworking. He had a tire shop, mechanic shop. And he said, over their 40 years that they ran the business, they went through some big ups and downs. They almost lost the shop a number of times, working hard, putting everything on the line to try to get this to work. Finally, eventually got to a point where they were able to sell the shop and sell the real estate that they'd bought the land of, essentially. And were finally able to retire. And then they found us, and we started helping them lend their money out. And so they started off with a very small, modest amount, and have continued to increase that amount. Now they're earning about $40,000 per month in interest income by sitting around and doing little to nothing.
Yeah.
And they said, man, if we had known about this years ago, we would have retired 10 years earlier.
Yeah.
And I look at that and I go, man, I wish I could teach that to more people so that, they can retire in their 50s when they've still got energy and time and time to, go and travel and enjoy their lives. And so that's just a small example. So, but even for the average person that's got 50,000, 100,000, 200,000, for them to be able to go and lend that money out and have that extra income. So that's the other really cool thing about it. Like if you're investing in the stock market, it's great. And over time, if you're doing some dollar cost averaging and you're consistently investing but there's not, unless you're just investing in dividend stocks, there's not a lot of income that comes off of that.
Right.
So you eventually have to sell off a piece to live off of that as you retire. So the awesome thing about private lending, of course, is that we're receiving monthly interest-only payments every month. And so for people that are looking for extra income, especially if they're going into retirement, it's a great piece. And here's the big cool thing that often a lot of people don't know as well, is that you can actually lend from your retirement accounts. Mm-hmm. So you can lend from your LIRA, your IRA, your 401k, as you guys call it, and in Canada, your RSP, your TFSA, et cetera, et cetera. So if you've got money sitting there, and oftentimes people have, they've got a pension or they've got, their contributions have gone into some sort of retirement account, and they're like, oh, it just kind of like loses money every year. Like I earn 27 cents in interest or whatever.
Yeah.
They can pivot that into a self-directed and actually start lending that out. So that's one of the coolest things that I love about it is, again, just helping people grow their retirement and be able to retire early.
Yeah. No, that's a great point about the retirement account. I was actually, you talked about it's not a get rich quick scheme and all of that. And it's so funny that people a lot of times will think that something like this is risky and avoid it. But I mean, at least in the US, like so many people are like, I put the money in my 401k and I put the money in my IRA because that's what I'm supposed to do. But that's also not a get rich quick scheme because you can't touch it until you're 65 plus or whatever. Like there's things that people do almost like you're like robotically programmed to do without actually thinking about, hey, what are my other options? And doing this through a self-directed IRA is kind of both, right? You're accomplishing both at the same time. And as you said, you're instead of selling off your stocks to, access that money, then you can live off the interest if you've got these things invested. So it paints a picture and you're emphasis on that, building for retirement and the length of time. Certainly, I would also say if I had started earlier, it would be better, just because of the amount of time that you have to build up those assets and have, cash flow coming off of them. So completely agree with that messaging. And this is, again, just another asset class, or I don't know, an arm of real estate that allows you to be a part of it in just a different way. So, and it's, this is probably as close to passive as you can get in the real estate world. Still work that goes with it, but a different kind of work.
What's interesting, and this is something that I love, is that if you ever track somebody's progress through real estate, usually there's a process that they go through where they're learning about real estate, they go out and buy some real estate, they own some real estate, and then they realize like, oh man, that's a lot of work. And they almost always turn into lenders.
Yep. Yeah.
Right. So
it's true.
I'll give you an example. So there's a really wealthy family here in Canada. They built the largest mall in Edmonton, Alberta in the late 70s, early 80s. And then they went and built the Mall of America in Minnesota.
Yeah.
And so they're, very smart real estate family, real estate developers. Guess what they own now? They own this huge company that lends money on residential properties and commercial properties.
Yeah.
And it's called People's Trust Company. And I'm not sure if they're lending in the US, but anyway, so it's just really interesting to see that progression that most people make, and even some of the my mentors and gurus that I follow, they're out there, they're working hard, they're building up this nest egg, and then essentially they're like, oh man, I'd rather just lend it out.
Yeah. Yeah, I would completely agree with that, just based on my podcast interviews. I mean, a lot of people that have been in it for a long time are at the point of, they're largely lending or mentoring, or kind of doing the stuff that experience and expertise are really helpful for. So I completely agree that is often the trajectory of people. Well, Steven, let me switch gears here. I want to make sure I get to ask you the questions I ask every guest. The first one is based on the name of the show being Know Your Why. So what is your why? What's driving you? You started us off with a really cool, inspiring story. So maybe you have another one for us here. But yeah, that's my big question to all my guests is what is your why?
For sure. Appreciate it. So in one of the mentoring programs that I'm in, they challenge us to create this big goal, a 5-year goal, and it's called our Mount Everest. So if we were going to plan to climb Mount Everest, what would that look like? Mm-hmm. And so this is my Mount Everest. It's to build a portfolio of 2,000 multifamily units, resulting in 100,000 net per month, so I can provide clean, safe, affordable homes for 2,000 individuals and families, and guide 250 new investors through their first multifamily deal, and teach 250 new investors how to lend their own money safely and securely, and launch the Shelley Loewer Foundation for entrepreneurship and financial literacy for high school students, honoring the legacy of my amazing mother.
That's fantastic. I love all of that.
There's a lot in there.
Yeah,
but
no, that's great. That's why I have this podcast, basically, is because before I started it, I would listen to other podcasts. I wanted to, get more involved in real estate, be an investor, all of that. And I kept listening, and it was like, okay, let's talk about, people would talk about, well, this is how you buy this house and rent it out and exit, or this is how you do a real estate syndication. This is how, whatever it was. But then the more I listened to, the more I thought the only thing that was important to me is like, why are they actually doing, like, what's the inspiration behind it? Yeah. Because otherwise it's kind of, I don't want to say it's boring. It's not boring, but it's a lot of the same stuff over and over again. And it gets really hard sometimes. And if you don't have a reason like that strong why behind what you're doing, you'll probably stop. Like, realistically, you'll probably stop. I don't think like being an entrepreneur, it's not always fun. And so it's like at some point you have to have something deeper that's driving you. And so I think it's just, so I appreciate you sharing that. And I think it's such a cool piece that I get to hear from people is like, what's important to you? Why does it matter? Mm-hmm. And so thank you for.
Yeah. And when I hear some other people's whys and some other people's, Mount Everest and stuff, I'm like, oh, dang, that's awesome.
Yeah.
That's not what drives me, but good for you. Like, that's really cool. Right. That, you're so passionate about, this or that, right? It's super cool.
And this is almost to episode 500. And so
wow,
I don't think that, certainly nobody's is the same.
Yeah.
Like, nobody has, it's like often involves some level of family, but it's not the same. Like, if you look at it at a deeper level, it's not just family. It's like, oh, well, inspired by my mother, like my kids are this, I have a child that's special needs, like all kinds of different things. People that want to retire their parents because they worked so hard for them when they were, there's just like a lot of it has to do with family, but it's not the same. And it can be such a powerful motivator. So I do appreciate you sharing that with us. Obviously it's meaningful to you. So, when people hear this and they want to connect with you, what's the best way for them to reach out?
Yeah, thanks. It's probably the best way to reach out is on Instagram. So it's just my full name, so at Steven Loewer. And I'd like to offer some value again to your listeners. So if anybody reaches out and just messages me the word Balara, I'll send you our private mortgage starter kit, which basically just breaks down, everything that we talked about in a nice, clean, concise way, shows people how to get started, what the next steps in the process would be, and how to analyze and just see if this is a good fit for you in where you're at in your life and with your investment goals. So reach out, and happy to provide a free kit for everybody.
Appreciate that very much. And it's Balara. It's spelled exactly like it sounds. So people, we'll put it in the show notes too, I guess. But as we discussed before this all started, sometimes people have trouble with names. But well, Steven, thank you for coming on the show today. Thanks for sharing all that you did. I think this is such a really, well, we have not talked about it a lot on this podcast, so it's not a new asset class, but it's probably new to a lot of my listeners. I appreciate the way that you explain it with clarity and ease so that people can understand it. So thank you for being here and sharing such an inspiring story about your mom. I really enjoyed the conversation.
Thank you. I appreciate it. It's been great.
Folks listening, make sure you connect with Steven. Go ahead and use the code and get the asset. I still get weird about my own name, I guess. But 500 episodes in, I still don't want to be the face of this podcast. But yeah, please connect with Steven. Get everything in the show notes. Please rate, and review the show so we can continue to get great guests. And as always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?